Good morning, everyone. I want to welcome everyone participating in today's webinar, Employee Benefit Plan Update and Red Flags for Administrators to Know. My name is Jennifer McCahill, and I'm an audit partner at GRF CPAs Advisors, formerly Gelman, Rosenberg, and Friedman, and I will be today's moderator. I'd like to start off with some quick housekeeping items and explain what you will need to do in order to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You will be asked to recall CPE words in order to receive credit. Please write down these CPE words when they are given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download after the webinar has concluded. You will also receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Nathan at the email provided on this slide. Today's learning objective is to provide attendees with a better understanding of the changes retirement plan managers and administrators should expect with SAS number 136, as well as the top risks to anticipate in 2020. Additionally, while we will be covering a number of items that are considered business as usual, we have also incorporated several updates related to retirement plans as a result of COVID-19 and the CARES Act that was enacted in March 27th of this year. We will touch on the changes under the CARE Act and give some advice for employers during this time of financial uncertainty and market volatility. One CPE credit is available for today's webinar. I'd like to go ahead and introduce you to our presenters for today's webinar. Mark Tassar is an audit supervisor with more than 10 years of experience on auditing tax-exempt organizations, including charities, foundations, associations, and other nonprofit entities. His background includes audits and reviews of employee benefit plans with specialized experience in internal control testing of financial, operational, and IT controls. Alejandra Jensen provides accounting and auditing services to an extensive number of nonprofit clients, including foundations, trade and membership associations, private voluntary organizations, and charitable institutions. She is also a key member of the Employee Benefit Plan Audit Team. Phil Lazzari is a senior partner and managing director at Snowden Lane. For over 23 years, Phil has partnered with business leaders, providing his knowledge and strategic thinking to build and sustain their company's financial success. He specializes in assisting business owners, corporate executives, and nonprofit governing boards by managing risk, consulting on concentrated stock positions, managing corporate cash, and exploring financial planning in the case of a liquidity event. Welcome to everyone, and I will now turn over the presentation to Mark.
All right, thanks, Jen. And thanks everyone for joining today's webinar. I hope everyone is doing well and staying safe through these unprecedented times. So our discussion this morning will be broken up into 3 sections. The first of which will be around general benefit plan information and a light refresher on when and how to determine if your plan needs an audit. The second session will be broken up into 2 parts actually. So in the first part, we'll discuss the CARES Act and the implications for employee benefit plans. And the second part will cover SAS 136 and how it'll impact your plan's audit process and reporting. And finally, for our last session, we're happy to have Phil Lazzari on the call today, and he'll walk us through some top risks and red flags that plan administrators should be aware of. So with that said, let's jump right into the material. So we're gonna put everybody to work right away and have you answer our first polling question, which is, are you currently subject to a retirement plan audit? A, yes, B, no, C, unsure. So please take a moment now to answer. While participants are submitting their answers, I'll provide the first CPE word. That first CPE word is salary. If you want to receive CPE credit, please jot these words down because you'll need them for the survey following the webinar. Again, the first CPE word is salary, S-A-L-A-R-Y. All right, so it looks like the majority of the folks on the line are currently subject to an audit. And this looks like about 35% are not, and we have C, unsure, which is about 9%. So hopefully, we have some good information for all the folks on the line. Hopefully we can reinforce the fact that you do need an audit, and if you don't need an audit, or you think you don't need an audit, hopefully, some of the information we provide can help you confirm or realize that you actually do. All right, so when do we need an audit? In order to understand when we need an audit, we first need to be familiar with ERISA, which is the Employee Retirement Income Security Act of 1974. Basically, these are the federal rules and regulations that govern employee benefit plans. They were enacted to protect plan participants to ensure that they're receiving the benefits promised in their plans. These regs are enforced by the Department of Labor as well as the IRS. And Title I is the specific section that addresses benefit plans. So the general rule is that when your plan reaches 100 participants or more, that's as of the beginning of the plan year, you would then be required to have an audit. All right, so if the general rule is based on 100 participants, it's important to understand how the IRS defines a participant. So the IRS considers the following to be a participant. It's an active employee who's participating in the plan. That's probably the most obvious one. It's a terminated employee that still is carrying a balance in the plan. And it's also any active employees that are eligible, even if they are electing not to participate. So this one is important to understand, and it's an area where we sometimes see plans miscalculate their participant count. So in order to avoid, any potential miscounting when it comes to these folks, we recommend and usually see most employers making every effort to get as many eligible employees into the plan as possible. All right. So as with most regulations and guidance, there's usually an exception to the general rule. In this case, it's the 80-120 rule for the benefit plan audit requirement. So any plan that fluctuates between 80 and 120 participants can elect to file in the same category as they did in the prior year. So just as an example, if you were a small plan with say 85 participants in your 2018 plan year, you did not have an audit requirement and you filed the short form 5500. So in 2019, your plan now has 105 participants. So the 80-120 rule would permit your plan to file the short form 5500 again, and still no audit would be required of your plan. It's important to note though that once your plan goes over that 120 participant mark, you'd now be required to have an audit. All right. So what plans are exempt? So some situations in which plans are exempt from the audit requirement, regardless of their size and number of participants. So if you're a governmental church or safe harbor plan, you're not subject to ERISA and therefore not required to have an audit. So a government plan is one established and maintained by a government agency of the United States. Church plans are established and maintained by a church or a convention. And safe harbor plans, which not to be confused with 401k or 403b safe harbors, which are used to meet matching requirements and comply with non-discrimination testing. These plans are actually funded solely through employee salary reductions and are not maintained by the employer. They're usually done through insurance contracts that are allocated to each individual. And again, if this is something, if you're not sure if you're a safe harbor plan that meets this category, certainly feel free to reach out to any one of us, and we can certainly assist with that determination. So that concludes our first session. So I'll turn it back over to Jen to walk us through our second polling question.
Great, thank you, Mark. So the second polling question, if your plan is subject to an audit, does it qualify for what is currently referred to as a DOL limited scope audit? A, yes, B, no, or C, just not sure. So while everyone's taking a moment to answer that polling question, we will go ahead and provide CPE word, and the second CPE word is scope. If you want to receive CPE credit, please do jot that down. You'll need that at the end for the survey. Again, second CPE word is scope, SCOPE. All right, interesting. So about 25% say you do elect the DOL limited scope. About 25% say you don't elect or don't qualify for a DOL limited scope. And some of you aren't sure, but we'll explain kind of what that limited scope audit really means in the next section. And it's a pretty common engagement and results in a little less test work. So we'll go into that in a little bit. All right, so before we jump into the changes with respect to the accounting standards, the SAS number 136, we're gonna actually touch on the changes as a result of the CARES Act. So everything that's been going on with the pandemic and the stimulus package and the CARES Act that was put into place in March 27th of this year did have implications for retirement plans. So we do want to touch on just a few of those changes as they're being rolled out even currently as we speak. So we want to make you all aware. So a couple of options for individuals. First and foremost, early withdrawal. So one of the changes under the CARES Act was early withdrawal from an eligible retirement plan, and this does include IRAs. So prior to the CARES Act, and normally if you're below 59 and a half years of age, you can't take money out of your retirement plan without incurring an additional 10% early withdrawal fee. So that's the normal implications of taking out money early. However, they have waived this fee, and so through the end of the year, you now can withdraw up to $100,000 or 100% of your vested balance. And before that was about 50% of your vested balance, but you could take that out without the fee, the early withdrawal fee, the 10%. However, it is important to note that if you do take out those funds, although you're not incurring that 10% fee, it still is income to you. So you would have to pay income tax on the amount that you withdrew. You're just not paying the fee. And under the regulations, the default to report that income is actually spread over 3 years beginning in 2020. So for example, if you took out $90,000, you could, or the default would be to report $30,000 in additional income starting this year, $30,000 in 21 and $30,000 in 2022. You can elect to report everything 100% of what you would draw within this year. But again, the default is that you spread it ratably over the 3 years. Also, if you feel that it's just a function of cash flow, it's a short-term loan, you think you'll be able to pay that back within 33 years, you can go ahead and avoid reporting that income as long as you do pay it back within the 3 years of when you receive those funds. So normally that time limit is 60 days. You have 60 days to pay it back and you wouldn't need to report it as income, and they've extended that to 3 years. So in order to take advantage of this, the taxpayer's spouse or dependent must have been diagnosed with COVID-19, or, which I feel will probably be more common, or you have had to have experienced financial hardship because of a quarantine, either layoff or reduced hours. So we're certainly anticipating maybe some of your employees taking advantage of this. So just do know that this provision is out there. Additionally, there's some changes with respect to loans. Again, they've increased the limit of an employee taking out a loan. Before it was $50,000. Now that has been increased to $100,000. And that's permitted within the next 180 days after that law was enacted. They also have made changes to employees with existing loans. If an employee did have an existing loan out there, they're able to delay payments for 1 year. So it's important to note that if you as an employer does not wish to incorporate these changes, you do need to reach out to either your third-party administrator or your custodian or trustee, whoever's really administering your plan, and talk to them about whether you will allow these options. So the way I interpret it is that TPAs and custodians and trustees will automatically start administering these changes if they don't hear from the employers. And then ultimately the employer will be responsible to amend your plan at a later date to reflect what was happening in practice during this time. But you do have some time, I believe through 2021, that you can amend the plan retroactively to reflect how the plan was operating during this time. So certainly some changes out there to consider, and if your employees are asking about this, please do be aware. So additionally, as employers are looking to free up some of the cash, during this time, or there are questions on how to reduce or eliminate employer contributions. There's a couple of options, less directly related to the CARES Act, but more in general, a discussion on what employers are able to do. So if you don't have a safe harbor plan, you might have a little bit more leeway as far as reducing or completely eliminating contributions. If you're matching discretionary, profit sharing, any in the employer piece on the contributions is subject to an annual determination, it's a bit easier to reduce or possibly eliminate. You would need to check with your plan document to make sure that you are able to reduce, suspend, eliminate, or it's at the discretion of management. But the one thing I will note that you need to be mindful of with this and the safe harbor plan that we will be talking about is that regardless if you reduce, eliminate, you still are ultimately going to be liable for passing your discrimination testing. So all the testing that top heavy and ACP and ADP contribution testing, you're still going to be required to pass all of those. So you do need to be mindful when you are reducing the implications that this will have on your year-end testing. So for the safe harbors, it can be a little bit more complicated. I think first you, as an employer, should really look to see if your plan document states whether you have the right to suspend your contributions for any reason in the middle of the plan year. So that is a provision that could already exist in your plan document, whether you're aware of it or not. It could say that you do have the right to suspend the contributions. If there is no plan provision in place, the IRS does allow you to drop or reduce contributions under a safe harbor plan if your business is losing money. So you'd have to substantiate that. And once again, you'd still need to ensure that you would pass your discrimination compliance testing at the end of the year. But for both of these, you can again work with your plan administrator, your third-party administrator, your ERISA attorney if they were responsible for writing your plan document, to see how you can look to amend the plan to potentially reduce or eliminate contributions for this year and potentially moving forward. So with that, I'm going to go ahead and turn it over to Alejandra.
Thank you, Jen, for that great overview. I will now be going into SAS number 136, forming an opinion and reporting on financial statements of employee benefit plans, subject to ERISA. This was created and proposed by the DOL in response. I'm sorry, I'm having some technical difficulties. All right, so why the change and update to the employee benefit plan audits? Well, back in 2015, the Employee Benefit Security Administration, or EBSA, of the DOL issued a report that noted a 39% deficiency rate among 400 plan audits reviewed. And they reviewed small and big plans in conjunction with big and small CPA firms. What they found is that firms and practitioners were cutting corners as it related to performing limited scope audits. In a limited scope audit, we obtained a certification from the custodian certifying that those investments and related activity are complete and accurate. And what they found is that practitioners were relying solely on those certifications and not performing sufficient audit procedures as a result. So in response to that report, the AICPA created and proposed Statement on Auditing Standard number 136. This was ultimately finalized and issued in July of 2019, so just last summer. This will become effective for plan years ending on or after December 15, 2020. So it will not have an effect on your 2019 plan audits that we will be performing in the next few weeks and months. It will become effective for your audits that will be under review next year. Early adoption is not permitted, so even if you wanted to early adopt, they are not allowing you to do so. So one of the objectives of SAS 136 is to provide readers with a better understanding of the scope of the audit, as well as make clear the responsibilities of the plan sponsor and the auditor. And we will talk about these more specifically on the next slide in a few moments. But because of the issues that were uncovered as a result of that study performed by the DOL, these limited scope audits have been scrutinized, and a lot of changes have been reflected as a result. With that in mind, I think the most significant change is the fact that these limited scope audits are going away. They are going to be referred to as ERISA Section 103A3C audits. And I think one of the biggest changes from that also is the change in the auditor's report for these ERISA plan financial statements. Language in the existing audit report has been reordered, clarified, and expanded in order to clearly express the audit opinion on ERISA plan financial statements. So if you are familiar with the current language in the audit reports for limited scope audits, you will see that the auditors disclaim an opinion on the plan's financial statement. And this, of course, has a negative connotation. Under the new standard, it still allows you to have a quote-unquote limited scope audit, but making that election is no longer considered a scope limitation. Also, requirements under SAS 136 include performing additional audit procedures on those investment certifications. For example, the certified information must agree with the information presented on the plan's financial statements, and audit procedures must be performed on all items not covered by the certification. So I think here at GRF, we've been doing a really good job of taking a detailed review of those certifications and making sure that if there's any items that are excluded, that we are performing additional procedures on those. So if you're a current client of ours, I don't think this will have much impact on you because we've been very diligent in ensuring that our audit procedures are sufficient over those areas that are excluded. Additionally, it goes on to clarify that the auditor should read the most recent plan instrument for the audit period and consider the plan's provisions when assessing the risk of material misstatement. So when we are performing our risk assessment procedures, we will be reviewing those relevant plan provisions and reporting whether those provisions have been complied with. All right, as I mentioned earlier, they have expanded on the plan sponsor and auditor's responsibilities as it relates to employee benefit plan audits. On the plan sponsor side, plan sponsors who elect to have an ERISA Section 103A3C audit will need to assess whether the entity issuing that certification is a qualified institution. They will also be responsible for ensuring that that certification meets ERISA requirements and for gaining an understanding as to which investments and disclosures are certified. And all of this must be acknowledged in writing, by the way. In addition, they are requiring this plan sponsor to understand and acknowledge its responsibility for maintaining a current plan document and amendment, and that they have maintained sufficient participant records in order to determine benefits currently due or that will become due to participants. So again, a lot more emphasis is being placed on the plan sponsor and their responsibilities. As far as the auditor's responsibilities, they have also expanded on our responsibilities, and one of those has to do with communicating on reportable findings to those charged with plan governance. And what they define as a reportable finding to be is one or more of the following: an identified instance of noncompliance or suspected noncompliance with laws or regulations, a finding arising from the audit that we, in our professional judgment, deem significant and relevant to those charged with governance, or an indication of deficiencies in internal control identified during the audit that we deem to be of sufficient importance to merit management's attention. And all of these reportable findings must be communicated in writing. This is similar to the existing rules in place, which are currently described as internal control material weaknesses and significant deficiencies. SAS 136 also has various other requirements, and one of those requirements is for us to read and identify the draft of the Form 5500 to determine if there's any material inconsistencies between what's reported in the plan's financial statements and that Form 5500. So again, I don't think this will have much of an impact if you are a current client. I think We do a very good job of obtaining those draft or preliminary Form 5500s, reviewing them in detail, and reconciling that information with what is being reported in the plan's financial statement. All right, so on this slide, I've taken a piece out of the auditor's report under SAS 136. This section highlights some of management's responsibilities, and a lot of this we've already discussed on the previous slide. But what I wanted to hone in on and focus on is that second paragraph where it goes on to say, in preparing the financial statements, management is required to evaluate whether there are any conditions or events that raise substantial doubt about the plan's ability to continue as a going concern. So while this report won't come into effect until plan year 2020, I think it's important to discuss because of all the changes that Jen mentioned as it relates to COVID-19 and the quarantine. You know, a lot of the financial markets have taken a huge dive. And so for your 2019 plan audits, we will be discussing with plan management to see where those plan assets, what the fair value of those plan assets are through the date of the audit report, and whether there's any material impairment. So we'll be talking with management and discussing if there's any additional disclosures that we will be including within the report. Obviously, for those that, you know, we perform the audits later in the summer or even early September. Hopefully by then the markets will have rebound, but at this point, everything is just extremely uncertain at this time. All right, and then I wanted to go back to the 5500. There's also been some proposed changes to the 5500. ERISA, the IRS, and the Pension Benefit Guaranty Corporation, they have been proposing several revisions to modernize the Form 5500. The revisions would include expanded information about group health plans, improved service provider fee information, and more detailed financial reporting. The greatest impact, however, I think, would fall on those small health and welfare plans, due to the fact that many of those plans are currently exempt from having to file the 5500. So if these proposed changes take place, that exemption soon would no longer apply. And they were originally proposing to implement these changes for plan year 2019, but that has been postponed and they have not given an update as to when they plan to implement. At this point, I do think that they have been taking a closer look into this, and it's definitely coming down the pipeline. So I would assume that maybe within the next year or two that these changes will be taking place, just because it's been talked about. So those are the changes to the 5500. I hope you all enjoyed the brief overview as far as it relates to plan year 2020 and SAS 136. I will now hand it back to Jen to go over your next polling question.
Okay, great. Thank you, Alejandra. So the third polling question is, do you plan to reduce employer contributions to your plan for 2020? A, yes. B, no. C, you're unsure. And we are going to provide the final CPE word. The final CPE word is sponsor. So once again, if you'd like to receive CPE credit, please go ahead and jot down the word sponsor. You'll need it at the completion of the webinar to complete the survey. Again, final CPE word is sponsor, S-P-O-N-S-O-R. All right, So the overwhelming majority of you do not plan to reduce employer contributions for 2020, which is fantastic. Some of you said yes, some just not sure yet, but obviously, with the uncertainty and moving forward, depending on where we'll land in the next several months, that could potentially change. But as of right now, with 75% of you saying no, that's great to hear. So I'd like to go ahead and turn the presentation over to our guest, Phil.
Thanks, Jen. Good morning, everyone, and thank you for having me on the call. I think when we started this process of figuring out topics, no one knew that we would be in the situation we're in. So these are trying times, and we're thinking of everyone out there on the call. So hopefully you'll find that these topics are actually fairly timely based on what's going on. I know that the plans that we advise on are fielding obviously a lot of higher contact from their employees about just kind of what the heck is going on, what do I do kind of scenarios. And I think, we're here to help, and hopefully these topics will resonate with what's going on, and you can take some of this back to your offices either remotely or when things go back to hopefully normal here in the near future. So we wanted to kind of talk about a couple of topics that our group finds are common questions and areas of concern when we're engaged with new companies in their 401k plans. So we can just go ahead and dive right into it. The first thing that we talk about is the word fiduciary. That's become a buzzword here over the last couple of years. The fiduciary standard as it pertains to retirement plans has actually been around since 2010. So we want you to understand kind of what it is, what your role is, and the different types. So if we look at the definition, if you will, of the word fiduciary, if you look at these types of, if you look at the explanations here, just glancing at it, the word that you see over and over again is the word trust. So when we talk about a fiduciary relationship or a fiduciary role, it tends to be one that people place faith in that you will make decisions for them for their best interests. And when it pertains to the actual 401k plan, some of the fiduciary roles are very clear and concise and black and white, and some there's some gray area as to who is responsible for what. The first area where you are in a fiduciary role is when you are on the plan document. So if you are the owner, the CFO, an HR representative, anyone who is on the plan document or has signing abilities is by definition a fiduciary. Anyone on the plan who is making discretionary decisions that will impact the employee base is a fiduciary. So certainly anyone who's signing for things is going to be in that role. But where we get questions are from others outside that. Well, am I a fiduciary? Well, let's think about that for a second. If you are on the finance committee that is meeting with the advisors or on the plan, that sort of thing, making decisions around investments or other plan amendments in making discretionary decisions, you are a fiduciary. And so what is your role? Anyone, at the end of the day, you have to put the interest of the employees in front of your own. That's the number one definition of fiduciary. But you also still have the rights to protect the organization. So there's a fine line. So we see this as something that people struggle with and understanding, should we do it ourselves or should we bring in a third party? And that's what we can kind of go into next. So when you're talking about fiduciaries, I would say that the number one issue that we see with our clientele is one of independence. And what do I mean by that? Well, many times there are wonderful platforms out there that we want to provide for our employee base. But sometimes, if they're self-administered, you're not in a position to where you can benchmark those platforms. So you want to have an outside advisor. Well, sometimes when you do that, you find yourself in a conflict of interest with that advisor, meaning, I'll take myself, for example. I've been doing this for a long time, and I used to work at a very large institution, and we had a wonderful proprietary platform that made sense for a lot of folks. But when the advisor also is an employee of the same company that is also providing the platform for the employees, at times there can be a conflict of interest. And so when we think about fiduciary in today's world in 2020, looking for outside advice, the number one thing you can do is add a layer of independence for that advice. So that means hiring a third party. And when you do that, there are typically two types of structures. One is called a 321 fiduciary advisor, and that's the most common. And two is what's called a 338 fiduciary relationship. What does that mean? So you go out and you interview people and you hire that person. Well, both of these roles will end up being a co-fiduciary coverage with you, the people on staff, the finance committee, the folks that are signing for the plan documents and so forth. Both 321 and 338 will be co-fiduciary and move some of the liability away from you into their role, okay? They're an independent, and if you look at the definitions and comparing the two, they serve in many different roles. The biggest difference between the two is that a 321 will partner with you, the representatives of the companies, to make joint decisions to benefit the employees. Again, you're going to be leaning on the advice of the 321 and making those decisions, but that's the role that we see the most. That's the role that, for example, I play in all the relationships that we have. Every once in a while, folks will want a 338 fiduciary coverage. That typically is for much larger plans, institutional plans, where they have a national landscape, thousands of employees, and it's too many to cover, so they hire someone to have complete discretion on making changes. So the biggest difference between a 321 and a 338 is that the 321 will consult with you, the finance committee, to make decisions, but then there will be an administrator at your company implementing those decisions on the platform. The 338 for larger plans has full discretion to make those changes on your behalf. Okay. So the number one thing that I would say before we move on to the next topic is, when you're talking about advisors and advice and fiduciaries, know your role. If you're in a position to make a discretionary decision, you are a fiduciary. We really recommend that folks hire third parties to help advise on plans, and most of you probably already do have advisors on your plans. Are they in a contractual 321 independent position, or if they are in a proprietary position where they work for the same company that is the platform, you may just want to address that and understand what if any, conflicts there may be. So again, we talk about proprietary and conflict of interest potentially there for advisors. Same thing in mutual funds. So mutual funds are the number one investment used in all of retirement plans, and so they're also the most important one in terms of understanding how they work. And so one of the things, and one of the red flags that we see, are finance committees don't understand share class. And what a share class means to a mutual fund or an investment, and then in turn to your employees. So mutual funds come in many different share classes, so there's A shares, B shares, C shares, and then in the retirement space, there are R shares. So these are different tiers of share classes, and all that really means is that they have different fees, okay? And so the larger size of the plans, you should have smaller fees than smaller plans. And everyone on this call, if you're having an audit and you've got over 100 employees, you probably have substantial balances in your plans. So you should really address the share class that you have, because that is the number one driver of fees in your plan. As fiduciaries, the number one thing that the DOL and all the white papers and all the research that we see is they want you as the fiduciaries to understand and be transparent about fees to both yourselves and the company and your employees. So when we look at these mutual funds, you have to understand something called revenue share. So what is a revenue share? A revenue share is a portion of the stated fee within each share class that is used to share amongst different entities in the plan, meaning the advisors, the plan provider, and there is a lump sum of fees that is non-disclosed that is used within the plan, and you have to understand how that works. So I'm big on examples. So what we've got here, a quick slide on a plan that we took over a couple of years ago. It was about a $15 million plan. So all the assets totaled up to $15 million, and they were using an R4 share class. That, the way that they had the balances within their funds, they were generating somewhere around $117,000 of total fees within the plan, of which 52,000 of that amount was under a revenue share, and it was not transparent as to where it was being spent. And so one of the things that we identified is we went back to the plan provider and we said, okay, well, where's that going? And so out of the $52,000 of revenue share, only $9,400 was required by the provider for revenue, meaning everybody out there everyone out there has a profit center. So it doesn't matter who you use, okay? Any plan provider, the best of them, they all have a certain required revenue that they need to maintain. That's their fee, that's their charge. Well, you need to know what that is. So in this particular case, the current plan provider had a required revenue of $9,400. Well, that left $44,000. Well, where's it going? You as fiduciaries need to know and ask those questions. Where is that going? Because that money, if you are in a revenue share, can be used for a lot of things that, you know, your audit representative can help you with. And it's called an ERISA bucket. You can pay for your audit. You can pay for your financial advisor. If I was hired on a plan, that money could be used to pay my fee. So you have to understand where your fees are going, what you're eligible for, and can you reduce the fees? Are you eligible for a different share class for your employees to pay less in fees? These are kind of the big topics that we see are very common. So understanding about fee transparency, your obligation, I've kind of talked about that throughout. Understanding all types of fees. There's going to be a provider fee. It doesn't matter who you use. There's wonderful companies out there. You know, we all know the names, okay? And they all have a certain fee that they need. You should ask, what is that required revenue? Mutual funds. What share classes are you eligible for? I will tell you that most providers now, because this topic is so important out there and there's so much scrutiny around transparency, most providers are offering the least expensive share class at pretty small balances. So if you have anywhere from $2 to $5 million in balances in your 401k, you're probably eligible for some of the least expensive share classes out there. Third-party administrators, you have to understand their fees. Advisors, the 321s out there, the 321 advisors like myself that you're hiring, what are they charging you? And how do you disclose this to your employees? And what's the most productive way for the company to pay for them? Some other really important things you need to know. Really, with our findings, the fiduciaries on this call, those that are making those discretionary decisions for the employees, the number one way you can safeguard your liability is to have proper policies and procedures in place and processes. So, you know, do you have an investment policy statement? Many people we find don't, okay? If you don't have one, if you're with a third-party advisor that is really committed to the industry, these policies can be developed on your behalf. You know, if you don't have one and you need one, if you just reach out to Jen or anyone on this call, they can get in touch with me. There's lots of templates out there that we use that we could be a sounding board for you. We're happy to give you some of those things. The policy statement will have your procedures on how often are you meeting as a committee. What is your procedures for identifying your mutual funds and reviewing your investments? How do you hire and fire your money managers or advisors? You know, that type of thing. And it's a very good thing to have in place. Plan benchmarking. How often do you review your plan? When was the last time you did that? You know, do you know what share class you have for your mutual funds? You know, a lot of times you don't review them because if you're not hearing complaints, you don't want to mess with it. I get it. But, you know, when you go through volatile times like this, you're going to have more and more people asking questions. Are you prepared with the proper answers? So we want to make sure you're covered. I'm going to skip to the last one real quick, and then I'm going to come back to employee education. So obviously the investment reviews on the, we're not going to go to this slide just yet, but I have an example of how you can do that. Let's talk about employee education real quick. This is going to be paramount. Okay, when you go back to work in the office setting, or if we're stuck doing this virtual for a long time, what are you prepared to do to educate your employees on what the heck is going on? Are you prepared to talk about market volatility? Are you prepared to talk about the mechanics of a 401k and how your dollar cost averaging every 2 weeks in your payroll? Are you prepared to talk to them about how to go about doing some of their planning for their long-term goals? Are they close to retirement? Are they still 10 years from retirement? What are you prepared to do? If you're not prepared, you need to start. You need to ask your advisor to help. So employee education is paramount, especially in these uncertain times. The last one I want to show you is a quick benchmarking tool on the last slide here we can go to. This is an 11-point criteria that we use. This is a third-party software. It's very common in the industry. It's called FI 360. So this is an easy way where an advisor can go in and plug your mutual funds into a program, and it'll give you a score on if it's a competitive program for your current situation. There's lots of tools out there. You all don't have to go crazy and pull hair out to try and, you know, attack all of these procedures that we talked about today. There are lots of people out there and lots of software tools that can really help and enhance the process for you and your employees. So those are, again, so just to kind of summarize, those are kind of the common things that we see over and over again as we're entering into these relationships. And I know we're running a little bit late on time, so I want to turn it back over to Jen so that we leave it for some Q&A. So thank you.
Great. Thank you so much, Bill. Very interesting and great points for business as usual as well as today's environment. So, so we did get a couple questions that I just want to go through and throw out there for the team. So the first one is, who is responsible for identifying when a plan is required to have an audit? Is this something that the TPA or administrator would do, or is it solely on the employer? Mark, do you want to take that one?
Yeah, absolutely. So, so good question. I think, you know, the responsibility falls certainly with the employer as the plan sponsor to be keeping track of your participants. That being said, though, you know, your TPA should also be working with you to provide alerts. I know a lot of you know, the TPAs will provide some alerts when you start to get close to that 100 participant mark, or even when you're over the 100 participant mark, they'll provide alerts to you, but it definitely falls to the sponsor and the employer to make sure that you're keeping track of the participants and being mindful of when an audit would be required.
Okay, great. Thank you. We had a question on whether we talked, I guess, about the limited scope, and someone out there asked if there are any changes to full scope audits during 2020.
Yeah, Jen, so I can take this one.
Great.
So as far as full scope audits for the 2020 plan year, those are no longer going to be referred to as full scope audits. They're going to be referred as non-ERISA section 103A3C audits. And most of the key elements for those full scope audits have remained the same, I would say. But as far as it relates to the auditor's report, there were some slight changes there as far as the opinion, as well as including expanded descriptions on management's responsibilities.
Okay, all right, great. And then actually, Alondra, I think there's another one that you could probably answer since this was your topic. It's so how will the SAS number 36 changes really affect plan administrators? It seems as though it's more geared towards the auditors.
Yeah, so for plan administrators, they will now be responsible for giving attestations that they have reviewed the certification and that they're in compliance with plan provisions. So while you might outsource this function, it's ultimately the responsibility of plan management to ensure compliance. And we will often see that there are errors in compliance even when outsourcing to big reputable institutions.
Okay. This one's for Phil. This one is, what questions should I be asking my advisors around mutual funds to ensure we are minimizing fees?
That's probably the most common one we get when we do these. That's a great one. And I would say, if you take anything away from what I talked about, this is the one. So the way to get started is to simply call your advisor and ask a couple of questions. One is, what share class am I in? Does that share class have a revenue share in it? And what is the required revenue of my plan sponsor? Those three things will get the ball rolling and get you right on track.
Okay, great. And then there was a question about, for the CARES Act provisions, what do I need to do in order to start implementing these changes? And so I think I mentioned that I believe your institution, your trustee, your custodian, whoever is holding your plan assets or administering your plan assets is going to start rolling these out, I think, almost immediately. So you do need to reach out to them just to make sure that the options are available to employees. If you want to communicate those options to your employees, that's completely up to you. And then they will probably give advice later in the year on how to amend your plan retroactively to reflect that these were in place and were occurring in practice during this time period. So with that, there are no other questions, at least for now. If you all do have questions, please just don't ever hesitate to reach out to any of us on the webinar. We have contact information here. We do like to thank you for attending today's webinar. Please do follow us on social media or visit our webpage. We have a whole webpage dedicated to COVID-19 alerts, changes, regulations and legislation is changing every day. So we're making sure to keep everyone up to date on the changes as they continue to roll out. So please do visit that webpage. And Please remember, if you do want CPE, to complete the survey with the CPE words. And again, thank you so much for attending today's webinar. Everyone stay safe, take care, and have a wonderful day.